Okay, so today's topic is excess depreciation related to non-current assets. Actually, it is the topic that normally students understand when they understand the concept of equity. Equity. First, we will go with the concept of equity. That equity is something in the start of the syllabus. We have studied that equity is something related to owner. The owner invested the amount. That's the equity. The owner's share in the business. That's the equity. The owner has the obviously business has some liabilities as well. That liabilities are not related to the owner. They are related to the company, but owners can't claim it as their own thing because they've invested the money. The profits are for the owner. The invested amount by the owner is for the owner, but loan is not the owner. That's the liability separate thing. So actually, there are some part of equity as well along with that invested things and profit. There is one part that is known as a revaluation reserve. What is revaluation reserve? That is also the part of equity. Why? Because whenever what revaluation reserve is something like that we have discussed here in the asset, that whenever in the last class when we studied revaluation gain and revaluation loss. So when the asset revalues and revalues upward mean it shows revaluation gain. In that case, what happened, you get some devaluation gain amount that we called as non-cash gain. In the last classes we have studied the non-cash gain. So that non-cash gain is the revaluation gain. Actually, that gain is something that is non-cash. We understand that is non-cash, but it doesn't mean that it has no value. Obviously, it has value in future. For example, the asset was, I have written example here. For example, there is an asset with a cost of 100,000 and depreciation is 5,000 multiply 5. 5,000 multiply 5 means 5,000 per year, and 5 years has gone. So 25,000 is accumulated depreciation and net book value is 75,000. And from 75,000, today's new value that we come to know for the asset is market value. New market value is 95,000. It means that there is the non-cash gain of 20,000. Non-cash gain of 20,000. We know, we understand that it's non-cash gain, but it doesn't mean that it doesn't have a value. It has a value. How? For example, right now, we take this asset to the market and sell it. We take this asset to the market and sell it. Obviously, the market will give us 95,000 because it's the market value of today. So it means this 20,000 has a value. If owner is selling the asset at the point at the point of revaluation, he will not get 75 or 76 or 78. He will get 95,000. So it means this revaluation gain is the part that has some value. Maybe not now, no, for now it's a non-cash, but for future it has a value, obviously. So this non-cash gain, that is revaluation gain, is something that actually is related to the owner, because owner owns the business and all the assets which will be having the revaluation gain. It will be the part of equity because it's related to owner can enjoy that. Owner can use this 20,000. If owner wants to sell the asset and enjoy this 20,000 right now, he can do it because it's a part of equity. So this 20,000 is gone as a part of equity under the revaluation reserve in front of gain as 20,000, where the equity is written. So where the equity is written is, it's actually the statement of changes in equity. I'm not going in detail in statement of changes in equity. I'm just telling you the point till excess depreciation, that in SOCIE statement of changes in equity, there are equity elements that are shown. In that equity elements, revaluation reserve and retained earnings are of our concern right now. So I'm only discussing that point. That devaluation reserve, we will write 20,000 as revaluation gain. We will put that value in that statement. Now, what will we do? Actually, the main topic we are going to do is the excess depreciation. So, excess depreciation. First of all, we come to know here that excess depreciation is something that is related to the revaluation. First of all, this is the should be the clear point, that if there is a revaluation in the asset, then there will be the point of excess depreciation. Excess depreciation is not other than revaluation concept. So, where there is a revaluation, there will always be excess depreciation. Now, till now, haven't discussed excess depreciation. We just discussed that non-cash gain, that is revaluation gain, is gone to revaluation reserve. Remember this revaluation reserve all only have non-cash items. Non-cash. Obviously, revaluation is something non-cash, and but this retained earning is something having the cash items, the actual cash items. For example, in real, we earn the profit of in the form of cash. For example, 20,000. So we will write here 20,000 in under retained earning. So retained earning is something that is not having any non-cash item. Non-cash item will be under the revaluation reserve, and non-cash item is basically revaluation reserve item. Other cash items is basically in retained earning. In other words, I can say that retained earnings have the real things. Real things mean that whenever the profit is realized, whenever actual profit comes, whenever actual cash item comes. So if you have to write it in equity part, you will write in retained earnings. All the cash items, the realized terms, realized profit will be under this retained earnings. And on all the non-cash items that are related to revaluation will be under revaluation reserve. Obviously, these both are the part of equity. Revaluation reserve, owner owns, retained earnings, owner owns. Because retained earnings is actually what retained earnings is. Basically, it's the earnings, all the earnings, all the profits of the last year and this year. If doesn't, if owner doesn't withdraw the profit, if owner doesn't withdraw the profit, all profits will be put in the retained earnings. So that's also something that owner owns. So actually, this is a game of equity game, equity statement. Then in one part is revaluation and another part is retained earnings. So under revaluation, we write the gain. Now, what is excess depreciation and what will we do with excess depreciation? Listen, actually, what happens when you assign the new value to asset? So I'm writing here the new cost of asset, that is 95,000, and cost old cost I can say is, old net book value I can say is 75,000. At the point of revaluation, it was 75,000. So what happened? This 20,000, this 20,000 was increased in the value of asset, and from now onward, the depreciation will be changed. Depreciation will not be according to the old net book value or old cost. Old cost, what was old cost? 100,000. If it was a straight line, then old cost. If it was reducing balance, then old net book value we were using. But obviously now you have the new cost. So depreciation is to be calculated again here, again here. Till now, what was the depreciation expense per year in our question? It is written
Per year 5,000.
per year 5,000. But now you have a new cost, so you will be having new depreciation. So let us calculate the
Yes.
new depreciation after revaluation. Okay, first thing here is that if we are maybe we're using I can say here, as I have multiplied the exact values for 5 years, so it's straight line. So for straight line, we will do, what we'll do is cost minus residual value divided by life. Okay, what was the cost? New cost 795,000. No residual value means zero. Okay, now we have to calculate here the life, remaining life. Obviously, we will not write here total life because now asset is revalued. And whenever asset is revalued, I told you in the revaluation concept, accumulated depreciation accounts gets nil, and you have to start the assets from new cost. So obviously, old life that has been gone, that is excluded, and from now onward, you have to see the remaining life. So till now, 5 years life has gone. 5 years life have gone. This is mentioned. But can you tell me what was the total life? Is it mentioned?
No.
What was the total life? Because out of the total life, we will deduct this 5 years and we will come to know the new remaining life. Is it given in the question?
No, it's not given in the question.
Yeah. Yes?
It is not given in the
It's
question.
not given. Okay, let me tell you now that it's given, but how you have to calculate. Listen. So I am going to calculate the remaining life here. So remaining life, how we have to calculate? See, we have 5 years gone, and per year depreciation was 5,000. Per year depreciation was 5,000. Whenever you want to calculate the life, total life, whenever first you will calculate the total life. First, I will calculate the total life. Then out of that, I will deduct five. Total life. Whenever you want to calculate the total life, what you have to do? You have to take cost divided by the total cost divided by depreciation per year. Depreciation per year. And if there is a residual value, you have to deduct this as well. Because obviously, if you use the formula of normal depreciation, let me write the normal depreciation formula. Depreciation is equal to cost minus residual value divided by life. Take the life here, take the depreciation here. Obviously, just I have rearranged it. So life is now on this side and depreciation per year you have in the question. So you have the cost. Old cost was 100,000, residual value 0 divided by what is the depreciation per year?
5,000.
5,000. So you will calculate the life, that is 20 years. This year, this asset life was 20 years at the start of asset life. So remaining life is 20 years. And how many years are gone?
5.
5 years. So remaining life is 15 years from now. Remaining life is 15 years. So you have to just make sure that you must be capable of calculating this total life and remaining life, so that you can use it in the new depreciation formula, excess depreciation formula. Okay, so life remaining is now is 15. So calculate it. What's the answer?
6,333.
6,333.33 per year. This is the new depreciation. So what is excess depreciation now? Excess depreciation by its word means the depreciation that is in excess to the old depreciation. So 6,333 is the new depreciation minus old depreciation was 5,000 per year. So excess depreciation per year is 1,333.33. Is it clear till now?
Yes, sir.
Okay, but listen, this is something that I told you related to the calculation of excess depreciation. But till now, we didn't completed this part that we have started from. So actually, what now will be there? What now will be there in the accounting? Now, actually, the main game is coming. Now, actually, the main point is coming. One point was the calculation. You have to do it very properly. Proper remaining life concept must be incorporated. Proper depreciation concept must be incorporated. Proper, you must be willing to calculate. You must be
Sir,
capable of
can the
calculating.
remaining, like can the total life be given in the question, or do we have to calculate every time?
Yes, you have to calculate it every time, but if it's given, then it's okay. You can use it. It's on the question, on the examiner, right?
Yes, yes, sir.
Okay. So now what happens that when we calculate this 1,333, it means that, now let me come to this point, that there was a asset that was depreciating 5,000, but now additional 166 what was it? Six additional
6,333.
1,333 was almost like depreciating more. So what happens? Let me tell you, I told you in SOCIE in the equity portion that in revaluation you have all non-cash item, and in retained earning you have all real items. Real items mean cash items. But real items are, let me tell you what are real items actually. Real item you can say, or realized items. That items that must be realized. Actually, when you take the benefit from anything, it means you have realized its value. You have realized its value. Like for example, this is the mobile, and this mobile per year, this mobile is for example of 100,000, and it has a life of, for example, 20 years. I have used it 1 year. It means I have realized its 5,000 amount, because per year depreciation is 5,000. So when I'll use it, I have taken the benefit. It means I have realized its value. Realized means I have taken the benefit from it. Maybe it's the cash item, maybe it's in the form of cash, maybe it's in the form of usage. Not only the cash item are the real item, but I will add here the usage is also the realized item, that if you use that asset, so let me tell you, let's tell me that this 20,000 gain, just focus on this. This 20,000 gain has how much excess depreciation per year? Due to this 20,000 gain, how much depreciation was increased?
1,333.33.
1,333. So actually, this 20,000 is non-cash. I know. It's non-cash item. But when you, yeah, when you use the asset after the point of revaluation to one first year end, means 1 year after the revaluation, when you will be doing the accounting, you will be seeing that okay, so it was 20,000 asset, and out of that I have used, taken the benefit of 1,333. Is that right? The point I'm saying.
Yes.
So you have used
After
that
1 year,
one
yes.
triple three out of 20,000. So what you will do, actually this one triple three out of that 20,000 gain, because this one triple three was due to 20,000. If there was no 20,000 gain, there will be no excess depreciation. So this excess depreciation is due to what, 20,000. And when 1 year has gone, year has gone, it means that 1 year gone, some part that you have taken the benefit from, some part that you have used the asset, you have realized that amount. This is not now, that one triple three part is now not now unrealized. Unrealized part was total 20,000, but out of that one triple three is used. So what you will do, you will deduct excess depreciation from this non-cash portion, one triple three point three, only the excess part, not total, because 5,000 was normal. It was, if you are not revaluing the asset,
Normal
5,000 was
depreciation.
normal. It is irrelevant. The above part, the excess part of the depreciation, that is one triple three, that should be deducted from here. And where it will go?
This did the left 20,000 minus 1,333.
20,000, 20,000 minus one triple three. I'm not asking about the answer. I'm asking about the point that it is deducted from the non-cash part, because it's now realized. So where the realized part are shown?
Retained earnings.
Retained earning. So you will take this part to this part, and you will write here
Mm.
one triple three point three three, because you have realized that income, you realize that benefit. Realize that benefit means you have used that asset. So you can't put that one triple three here now, because that is now not non-cash. You have realized that, you will take that part of excess depreciation to retained earning part. Is that clear till now?
Sir, can you explain this 1,333 in the retained earnings one more time?
The part of this revaluation to retained earnings.
Yes, yes. This excess
Yes, so let me
depreciation
tell you.
taken from
Let
the
me tell you
retained
again.
earnings.
Actually, 5,000 was irrelevant. It was old depreciation as well. This one triple three was excess depreciation above the above the normal depreciation due to revaluation, and revaluation gain was 20,000. So 20,000 was the part of the asset, that the extra part of the asset above the normal value, that was the revaluation non-cash gain. So non-cash gain was written in the reserves. Reserves mean revaluation reserves in the under the part of equity. But when after 1 year, when you use the asset, you come to know that additional one triple three amount of depreciation is to be charged. It means you have taken the it means you have taken the depreciation. You have used the asset. You have used the asset mean that you have taken the benefit of one triple three from that 20,000 gain part, because if there was no gain, there was no depreciation. So you can't
Yes.
do it like, that excess depreciation, you have used the asset and you say that okay, 20,000 revaluation reserve in there, so let it be in the 20,000. No, actually the part that is now realized, that should be shifted from revaluation to retained earnings. Clear till now? Clear this point?
Yes, okay.
So you have to
Yes, because
shift
you have
this
used
part.
that excess
Yes,
depreciation, so it's taken to the return earnings because it's in the
you have to
usage.
shift. Yes, you have to shift this part from revaluation reserve to retained earning.
Uh,
But now, how much revaluation reserve will be left here?
18,666.7.
18,666.7. But obviously, the main part that we have to study, that we have to understand, was this part one triple three, that we have to deduct from here and we'll take here. Okay, what's the nature of equity? Is it debit or credit?
Credit.
Credit.
So, sir, we have taken the benefit of the asset, 1,333 for 1 year. So now that is it was a non-cash at the moment because now we have realized it, the realized gain. So we're taking to the return earnings because it's now a cash item.
Yes. The point that you have to that you have to understand, main point, that realized things are basically two things. One is the, if any thing is generating the cash and you are receiving the in the cash form, then it's realized. Second thing, if you are taking the benefit from anything and you have already taken the benefit, so you will take assume it as a realized, because you have realized the benefit. So realize the benefit means also you have to take it out of the non-cash thing and take it to the retained earnings, realized items, as a realized items.
Mhm.
Is it clear?
Yes, sir. Yes.
Okay. Now we have to make the entry for excess depreciation. So here I am going to make the entry for excess depreciation. So excess depreciation has what effect? Excess depreciation has only one effect in the statement, that it was written and it was deducted from devaluation reserve and has gone to retained earnings. So as equity is credited, obviously revaluation reserve nature will be credited, retained earning will be credited, because as equity is credited, they are also the part of equity. So from revaluation reserve, this part is deducting. Revaluation from excess depreciation is deducting, means it is lowering the amount of revaluation reserve. It is lowering the amount. It is decreasing the amount of revaluation reserve. So here revaluation reserve will be debited or credited.
Evaluation will be
The nature is credit. But if revaluation reserve is deducting, getting lower, then
then
the,
debit.
yes, we will debit it. Because why? Why? Because it's deducted, it's getting lower. When obviously the nature of the asset is debit. When it increases, we debit it. When it decreases, we credit it. Simple. Same like that. Revaluation reserve nature is credit. When it increases, it's debited, it's credited, and when it's decreasing, it's debited. Simple. So what you have to do is you have to debit the revaluation reserve account by the amount of 1,333 each year, because each year 1,333 is excess depreciation. And what will we credit here?
Retain earnings.
Retained earnings, because retained earnings is also
Retain
equity.
earnings.
So retained earnings is credited 1,333. So that is the entry of retained earnings. Actually, this whole story I have told step by step, but you have to just learn it. Debit rebate. Just you have to understand the concept that excess depreciation goes from retained earnings to goes from revaluation reserve to retained earnings. Just learn the entry. Debit revaluation reserve, credit retained earnings, and just you must be aware of the calculations of that as well. So that first calculate revaluation reserve and just make the entry debit revaluation reserve, credit retained earnings. This is all the concept behind that, but you don't have to explain it in the exam. They will ask the double entry or they will ask the value. So you have to calculate the value and put it in the double entry, right?
Yes, yes.
Let me give you one question, or let's try the kit question if there is any. Let's try the kit question. Maybe there are any question related to that.
So these effect does not go to the SOFP or to the statement of profit or loss.
Okay, so see, there is a question that first you have to do. I will do it, but first you have to do for the practice. Trapper company uses revaluation model when accounting for land and building and makes an annual transfer of excess depreciation. Annual transfer of excess depreciation means when you transfer the revaluation reserve to retained earning, the excess depreciation is transferred from here to here. Here deduct and here it's added, if you remember. So actually, this is known
Yes.
as transfer of excess depreciation from revaluation reserve to retained earnings. Following the most recent Following the most recent revaluation, Draper Company calculated that the annual amount of excess depreciation was 8,000. He has given you excess depreciation. What will be the entry here?
See, revaluation surplus 8,000
Revaluation
debit and
surplus,
retain
simple.
earnings credit.
Yes. Yes, simple. You will do C answer. Clear? Is it clear?
Yes. Yes. Yes.
Okay, let's do another question as well. This is the question here, 193. This is, I think, something like a proper calculation. You have to do it now and let me know what's the answer. You have to calculate the annual transfer of excess depreciation. So here you have to not make the entry, you have to calculate excess depreciation. Calculate it and send me to the WhatsApp the picture of the solution.
Okay, sir, I'll try.
Okay, so this question I've checked that is correct. Let us do it. The value was the cost, first cost was 480,000, and accumulated depreciation, the carrying amount was 384,000. So accumulated depreciation obviously was 96,000 till this point. So obviously we have to know that how much life has gone, because after that he's saying that this asset has a new net book value of 600,000, but obviously sorry, new cost of 600,000, and for that 600,000 we have to calculate the life to calculate the new depreciation, because old depreciation, first we have to calculate old depreciation as well, but it will be calculated once we will be having the uh, 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 yes, he's saying that 2% straight line is a plan. So 2% we can calculate 1 year depreciation. So if you see the 1 year depreciation, so it is 2%. 2%. If you calculate 2%, it is like 480,000. 480,000 multiplied 2% is basically 9600 per annum. And till now, the cumulative depreciation is 96,000. It means if you divide accumulated depreciation over depreciation per year, so you come to know that life that has actually gone is 10 years. Life that has actually gone is 10 years.